Welcome to Markets Now. I'm Michelle Rook with Chuck Shelby of Risk Management Commodities, and we had a mostly lower day in grains, mostly higher in livestock. And let's talk about the pause that we have seen in the grain markets here, Chuck. How much of it is just we had a good run up off the tariff lows, and it looks like we're running up into some chart resistance here?
Yeah, very nice rally from the lows. We got through the report. We've also seen significant fall in the U.S. dollar. So a market that had a good run. We got this holiday coming up on the weekend with all the turmoil and different things that could happen. I think it's just kind of a normal thing to happen here. We saw unwinding of the bull spreads. The back end months were still in positive territory for most of the day. So overall, not a bad performance as producers are getting ready to head to the field and get the new crop planted for the 2025 crop.
Soybeans could not get through the 200-day moving average. Will we get through that level, or does it keep stopping us out, you think?
I think we've gone down low enough, and I think, again, if the dollar continues to drift lower, that certainly makes our beans more competitive. We're seeing other world buyers step up, even though China's, ignoring the United States and not really buying anything from us. I think it has the ability to do that. Ultimately, what it's going to come down to, I think, when you look at the acres, if the USDA is correct and acres drop as much in soybeans as they're predicting, you're going to have a really record yield to keep the yield up there and the carryouts to not fall below certain levels. If you had a 50 bushel yield, your carryout could get down near 200 or below. So I think there's support there. It's certainly going to watch, what the yield is and what USDA predicts going forward. But I think at these price levels, as long as we've been in such a long downtrend, we have the ability to maybe push above the 200-day, which is a long-term trend indicator. Broken that downtrend line, that would be very important.
Yeah, corn has had a tough time getting above the 62% retracement level here, even with some export business this morning. There again, do you think we have enough gas in the tank to get through that level?
It's probably going to, depend upon, how this crop turns out. I mean, a 62% retracement is a pretty good retracement. We've seen world buyers step in. I think the other component is there's still ideas out there. Export pace is so far ahead that USDA needs to probably increase exports as we move into the growing season. Maybe another 100 million bushel needs to come off of there. So the market's aware of that. As long as these exports keep pace and do well, I think there's a good chance with some uncertainty on the weather and not knowing what the crop's going to be that we can push above those levels.
And you mentioned the dollar's been helping us out. The big pullback that we have, how much does that offset some of these 10% universal tariffs?
Kind of interesting. It's about a 10% decline in the US dollar, which nicely matches up with those 10% tariffs. So, it's a significant change. The dollar had been on a big run to the upside. I mean, possibly could go down into the 90s, the low 90s, which would, make it even more competitive for our U.S. exports of grain. So it looks like the dollar's peaked out. Good news for producers as we move into summer.
Yeah, like you said, it makes us more competitive. Do you expect more of these sales here before the 90-day delay and we find out if we get tariffs or not? Will there be that front loading?
I think there's some countries that are looking at that. I would like to see some of these more bigger major countries. Sounds like they're going to resolve this, and would like to see some concrete, agreements being made. I think that's something we need to watch in the next couple of weeks here to see if anything really can be done and we get some agreements. And if that happens, then maybe we don't see front running. We just see constant business, and it makes sense for that to happen if it can get a deal done.
Yeah. The wheat market is the one where demand maybe is a little lackluster, though, right?
Yeah, we're still fighting that battle. We can't seem to get the wheat market to respond like the corn and beans have, and it's a struggle. I guess we would have thought there'd been bigger reaction to wheat with the dollar being down so much, but it just seems to kind of float around here, and we just can't seem to turn the corner in wheat. We still have the Russians and the wars going on. Russia's still pushing wheat out the door, probably below the real market value in the world.
Yeah. Has weather been a factor here?
Well, they've the most recent forecast kind of pushes the rain again further to the east. There were ideas there'd be quite a bit of rain in the west, but it doesn't appear that currently that's really going to happen. So I think if it doesn't rain as much to the west, that can turn that market around. I know here in the east, when you look at the soft red wheat, it may appear better than it really is because too much rain is not good for wheat, and the roots are getting saturated. We got another round of rain coming over the holiday weekend. If you grow wheat, might have leached out your nitrogen if you put it on there. So the wheat in the eastern areas, even though the ratings might look fairly good, I have to question too much rain on wheat early on is not the best for getting a big time yield.
Yeah. So you think that's a false reading, and if we get more rain, you could get some big disease issues there, some abandonment maybe even?
Yeah, disease and again loss of nitrogen are two factors on that. So it might take another month to really see how the wheat turns out. But yeah, I could see some farmers in the east here, if their wheat crop's not looking that good, the disease, the loss of nitrogen, could be turned into bean acres going forward.
How much wiggle room do we have for any planting or weather problems here this season?
I think when we look at corn, especially, I think the USDA currently might be underestimating the demand for exports. And when you snug that in there with the 95 million acres and probably going to project, a record 181, 182 type yield. If you take that yield down to 176, 177, 175, it really tightens things up pretty significantly. So it's important to see what this yield's going to be. I think they're going to keep some weather premium in corn and beans as we move forward because the trade's seen what happens in the last year or two when USDA projected 2 billion crop. By the time we get down the road 9 months or a year, they've reduced that, whether it be through a yield reduction or better usage than they predicted. So I think the trade's seen that for a couple of years, and I think they're very aware that a reduction in yield, a 176 is still a great yield, but it would sure tighten things up significantly.
Right. And so if we get a weather issue, especially because the funds are pretty short in soybeans, they're not that long in the corn, there's some room for them to add on to those positions, right?
Yeah, as producers, we didn't like it when the funds got out and, drove the market down. But again, as you mentioned, that allows them plenty of room to come back in here for any kind of weather scare, any kind of issues that go on as we move into the growing season. So it's been a good thing. And I think there certainly is a reason for concern when, you're going to have to project a 181 or 182 type yield to just increase the carry out from where we are today.
So Chuck, let's talk about the cattle market. We did into the plus side. We've been having trouble getting that June contract and the live cattle futures above that $200 level. So, what is your thought? Are the funds going to be able to stay in here long enough to push us over those levels or not?
We've seen a big liquidation of funds. They were a big push in the cattle markets to the all-time highs. But I think when you look at the fundamental side of it, the cash is still extremely strong. We're entered into that grilling season in the next 6 weeks, which I think consumers are still going to be spending the money as we look towards Memorial Day holiday. So I think the cash is a leader. I think the futures are still reacting to the tariffs and the stock market, but eventually cash being as strong as I believe it will hold as we move into the next month or so, that'll have to blend with the futures, and eventually the funds will have to, meet the cash market. So I think it's just a liquidation phase, but cash is king in the cattle market, and I look for that to remain very strong.
And we are not even into the best part of the demand season for beef yet, are we?
I look for that to still be very strong here. I mean, consumers are cutting back some, but when we have these holidays, I've always believed that unless we're in a deep, deep recession, the consumers are going to, want to get out, get together for holidays. So I still think the demand's going to be very robust.
So hogs ending mostly higher here. I think the June contract looks like it's run up into a little resistance now that it's kind of the biggest spot month anyways. Do you think we're at fair market value here for this hog market after we've gone through some of these tariff trepidations?
Yeah, I think the hogs are a little different situation than the cattle. We send a lot of pork to China. They've obviously, with the tariffs and backing off, I think the hogs probably are at a fair value for what we know today. Again, the positive side of the equation would be U.S. demand here as we move into the grilling season. It's a cheaper cut of, for consumers when they go out to eat or when they're going to cook at home. So I think this value level here is probably justified. And as we move forward, we'll just have to look for, new demand as we move into the month of May.
Absolutely. All right. Thanks so much for joining us. Chuck Shelby with Risk Management Commodities. That is Markets Now.